to your Monday Futures Market Outlook for October 17th, 2011. This is Patrick Ceresna. For those of you that have not had the opportunity to try out eMoneySource.com's trading room, 5-day complimentary memberships are available on the website. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and we plot an 80-week moving average on there. It does a very good job to depict the bull and bear market cycles that we've gone through. We bearishly crossed below that 80-week moving average during this last market consolidation, and we've now seen some sort of a short-term swing low. The question becomes now, was that sufficient selling to allow the stock market to have some form of a sustained close above this 80-week moving average? Nonetheless, we continue to hover along this zone, and while probably for the remainder of this year we may have markets that can maintain and hold these types of levels, if not even much higher, but the 2012 year could see another resumption in and test even the 1,000 level on the S&P, but let's worry about that in the new year. Just to review our key intermarket observations, we've seen key bottoms on stocks and commodities, but in just 2 weeks in this rally, we are already at the top end of the range with substantial overhead resistance. This also came along the same time as we've seen the topping formations on 30-year Treasury bonds and a full retracement of the US dollar after that big push. Now, overall, even though we've sort of already had these extended moves, we generally are optimistic about the remainder of this year, but it doesn't necessarily mean that 2012 will be a good year. But probably until the end of November here, we should have markets that taper off from all the selling pressure we've seen over the last 2 months, and really more than likely we're going to see far more range-bound, if not advancing markets. When we take a closer look at that S&P 500, you can see how we're already approaching key overhead resistance levels. While it was just 2 weeks ago that we were trading down below 1100, we're now already testing and have exceeded even the highs of the first week of September, last week of August. And really, there is room, obviously, for this market to maybe even push as high as 1250, 1260 in this go. But more than likely, off of these highs here, we are going to see some sort of a full retracement that could see the market even take 60 to 80 S&P points off as it fully retraces back towards even 1150 on the downside. After even a solid 2-3 days of selling, we probably will see in the next good buying opportunity. We don't fully expect it to be a sell-off that has a massive spill lower, so we'll be looking for weakness to buy. When we take a closer look at that S&P 500, you can see that just 2 weeks ago we were down at the lows creating that double bottom, but right now we find ourselves virtually at the top end of that, all those major overhead resistance levels just 2 weeks later. This overall makes the risk reward proposition of going along here very poor. More than likely we're going to have a retracement lower. Now that blue arrow down suggests even the 1200 kind of area, but a retracement could even be 60 to 80 S&P points on the downside. We could even see a test of 1150 on the lower end. Nonetheless, at this stage, the market represents a poor risk reward for continuing to chase it. But as soon as we have any good pullback that could be bought, there should be another opportunity to make money on the upside. Next year, when we take a look at the US dollar index, we're now seeing a full retracement of that big breakout on the upside. More than likely, all US dollar selling should be contained to the 76 area where all the previous highs occurred during the summer. Really, if that level successfully holds and contains all selling, the US dollar at some stage into the end of the year should have another push higher. Next year, when we take a look at copper futures, copper has had a very substantial sell-off and is actually doing a pretty poor job at retracing, even though we're already 40 cents off the low on the upside. The fact that there's no substantial follow-through indicates that some sort of another short-term high should come in on copper within the next 10 to 20 cents on the upside, maybe a maximum of like a 370 upside on the short term. Once a short term high is banged out, if that corresponds with a swing low in the US dollar, we could still have another drop in copper to retest the lows around the $3 area in the upcoming couple months. Next year, when we take a look at gold futures, and gold really is creating that same retracement that copper is. It really has done very little to retrace that very dramatic sell-off in gold. At this stage, we anticipate that while gold can go to 1700, maybe 1750 on the upside into this retracement zone, gold at some stage will have another sell-off to retest the 1550 to 1600 zone down below. Next year, when we take a look at crude oil has put in a double bottom, and just like the stock market is approaching its overhead resistance levels. Again, I anticipate that while crude oil may strengthen even over the next few weeks and probably fully test the 90-92 area, we anticipate that there should be substantial overhead resistance into that, and it should be relatively difficult for crude oil to make any substantial progress without at least creating some sort of a consolidation point to reconfirm that some sort of low is in on crude. Finally, I want to take a look at those 30-year Treasury bonds, and we've seen that double top up along the Treasury bonds and a break of the neckline. And while that leaves room for Treasuries to retest even as low as the 134, 135, actually we believe that there's a legitimate chance that after it finds a short-term low here, the Treasuries will make a solid retest back up. Whether they make it all the way back to 146 is uncertain, but we should have at some stage a proper pull, proper rally back up towards a 142 area on the upside. That was your Monday Futures Market Outlook. Thank you for joining me.